Good morning, everyone. Welcome to this update for global stocks and commodities for the 9th of December. The week we've just had was the most volatile week of the year, and we had whipsawing backwards and forwards on several occasions, basically driven by news events. And there's a real negative tone to the market at the moment. So it's a market that's tough to negotiate, but when you step back and really look at what changed during the week, despite the incredible volatility, nothing's actually changed. You know, the trade war situation is not a lot different from where it was. The situation with interest rates is not a lot different to what we had the week before. The outlook for the US economy hasn't really changed. So there isn't very much that's actually different. It's just the market is now taking an incredibly negative view of virtually anything at all. So I want to take a look at that because it's certainly a tough market to negotiate at the moment. That's for sure. So I guess I pose the question: why such a poor week if nothing has changed? And the shifts in sentiment from day to day and even intraday were quite extraordinary. But from my perspective, nothing has really changed fundamentally. You know, yes, there's a few things around the edges, but and I know that a lot of media attention has been focused on the inversion of the short-term bond yields, but that doesn't really change the bigger picture at all. And certainly, technically, nothing has changed either, as you will see from the charts. I think the issue is it just feels bad, and you know, everyone has got very negative about the market, and you mix that with the computer algorithms, which are, they're just they're amplifying the moves, and the whole market all around the world, no matter where you look, just looks and feels bad, but it's not actually nearly as bad as it feels. So we'll take a look at the normal stock and commodity trend update. And Portfolio Analyst last week, amongst other things, I looked at opportunities in the Australian high flyers. So the stocks, the growth stocks that had done remarkably well, stocks like Afterpay Touch, LTM, WiseTech Global, those sort of stocks, to see whether they'd pull back far enough to be worthy of going back into. So I think that was a pretty good session. So let's take a look at what happened last week. The S&P did not bounce hard. Sorry, I hadn't actually amended that top line. The S&P index was down quite sharply, as you would have seen. And it was really a combination of throwing the dummy out of the cot and the computer algorithms just amplifying all that negativity. And, hey presto, we end up with an incredibly volatile week. And I think what I'm seeing is that each piece of news, whether it's on the trade situation or interest rates or whatever it might be, is being extrapolated to a bad outcome. I mean, that's what the market is doing. No matter what it is, I think people are looking very much at a glass half empty kind of environment. And it's a bit of a toxic mix, and prices are under pressure as a result. Now, yes, global growth is slowing. We're seeing slowing in parts of Europe. Certainly Japan is now starting to go backwards again. The UK economy is a huge question mark with respect to Brexit. And China is slowing a little bit, but I don't think China's nearly the problem that a lot of people are trying to make out. But there's no question now that we've moved from synchronized global growth that we had last year, where all the economies were firing, to now we've got a lot of the world outside of America is actually is slowing. The growth rate is slowing. But amongst that, the US economy marches on. Now, there's a few issues with America. There's some signs there that the housing market is turning down. But traditionally, the housing market in America is very much a lead indicator, and it often will move down several years ahead of a recession in the US, So it's not one to be, overly concerned about at the moment, particularly when there are so many other positives with the US economy still. Now, the other big thing, of course, that is really disturbing markets is we got some bond inversions of the shorter term rates, the 2, 3 and 5 year yields rolling over. But the main one, the important one, the 2 and the 10-year spread has not rolled over yet, and yet all this attention is on the fact that it's virtually a done deal. Well, that's not necessarily the case. And also, if you look at history, a flat or even slightly inverted yield curve doesn't necessarily mean lower prices. We've had instances before where the yield curve has gone flat, and yet prices have risen in the S&P for 2 to 3 years after it happened. So, the message here is there's no need to panic just because the yield curves have inverted. It's not necessarily an issue. It's not something to be ignored, but it's not necessarily an issue. The other point that I want to make is that when I'm looking through a couple of hundred individual stock charts in the US over the weekend, the volumes were not particularly high on Friday. The price moves were ugly. They really did look bad, but the volumes were generally pretty modest. There certainly weren't any really large volume spikes. There wasn't any real committed selling. So that's just another point to note. Now the US dollar was down slightly on the week, and the high yield debt ETF HYG, which we'll take a look at, was down again. So it's had a little bit of a blip the week before, but it's turned back down again. But that's sort of what you'd expect to see at this stage of the economic cycle. But the 10-year Treasury yield, which had got up to about 3.25, and everybody assumed was going to continue to head up towards 4, which would have been a really negative for stocks, has actually rolled over and fallen back down to 2.85, which is quite unexpected. So let's jump in and take a look at some of the price charts. This is the S&P to start with. So we had, let me just pan back and get a big picture here. So we had a really, really strong rise. Obviously going up to the peak in January of this year. And then since January of this year, I'll just tighten in on that, that has really defined the range of the market. And the market has basically just stayed within that range between 25, the low 2500s to, we got up to about 2950. So about a 400 point range for this year. So we've got a big picture trading range. Is this reaccumulation before the next leg up, or is it distribution at the start of a bear market? You can't say at this stage, and anyone who proclaims a direction from here is purely guessing. There is nothing in this chart to indicate which way the S&P is likely to go on a longer term perspective. And if you look at this period here, let me take you back to 2015, 2016. There it is there. There's the start of, we had a bit of a break in August of 2015, and then this is January and February of 2016 when we broke the lows. Everybody thought that we were then into a bear market, including me, but the market quickly turned around after only a couple of weeks and went back up again. And this was significantly lower than the 200-day moving average, and you notice that the 200-day moving average had actually rolled over and was starting to point downwards. So fast forward to today, and the S&P, by the way, then was the S&P was sitting around about 1850 points. So fast forward to today, and we've got a quite similar pattern, not as severe as 2016, because we're not as far under the moving average. The moving average hasn't really turned over yet; it's flat, and yet the S&P is 1,000 points higher. So there's no need to panic just yet. The primary trend is still up. Now, I'm not discounting the possibility that this could be the end of the 10-year bull market, but at this stage, that is not the case. We're still in a period of sideways trading, so please remember that. Now, coming in a little bit tighter, and we've now got a range that's been defined by the start of the correction in October, and that's got a boundary of roughly 2600 to 2820. And despite a horrid week, we're still within that range. We haven't broken those lows. So just to look at the week that we had, this was Friday of last week. Obviously, we'd had a bit of a rise. The rise that occurred in the week before last was as a result of the Federal Reserve changing their tone, their rhetoric on the rate of future interest rate rises. The market loved that, and it moved up accordingly. And then on the weekend, we got some positive indications from the US and China about their trade dispute, and we got a big gap up on Monday. So this little bar here is Monday's price action. So the market gapped up, traded up a little bit, but then lost it. And that did concern me, and I stated that to members in my communication to everyone on Tuesday. And then, of course, we got some bond inversion. We got the White House putting a bit of a different spin on the negotiations, and the market got sold off very heavily on Tuesday night. Wednesday, the market was closed, but futures went down, and so the market gapped down. So it closed here at around 2,700 points. It then opened on Thursday down another 37 points, traded right down. So this looked absolutely horrible halfway through Thursday night, but then staged a huge late rally with, in fact, enormous buying in the last 10 minutes. If this isn't computer program trading, I don't know what is. So we got an amazing turnaround. We then got some higher trading on Friday, but then it all got lost again. So to me, this is just a big washing machine of computer-driven trading, because human beings can't change their mind that emphatically over such short periods of time. These are markets that are being driven by computer programs. As a result, you've got to step back a little bit, because it's very easy to get whipsawed in and out of this sort of market if you start responding to the day-to-day news events and the day-to-day volatility. So I think that's one of the important points I want to get across today. You just don't get stuck in the middle of this day-to-day chopping backwards and forwards. So that's the S&P. If we look at the NASDAQ's a little weaker. You can see we've got, as opposed to the S&P where we don't have, we've got basically a range. With the NASDAQ, we've got lower highs and we've got lower lows. So we do actually have a downtrending channel in the NASDAQ. And if we look at the small cap Russell 2000, it's the same situation, except it's more deeply underneath the 200-day moving average, which is now turned over. So a bit of a mixed picture in America, but for me, the primary trend in the S&P is still to the upside. Now, I'll take a look at HYG. So we had a breakdown a few weeks ago. So we had a breakdown through here. In fact, let's take that up. Ignoring that little spike, let's take it up here to the previous support levels that were over here as well, which gives us, I think, a more accurate picture of what's going on. So we had a breakdown in the high yield corporate debt, which is exactly what you'd expect given what's going on. We got a brief rally the week before last, and then it all fell away again. So we've got high yield corporate debt heading down, which means yields are going up. And look, honestly, if this wasn't happening, it'd just be the most unusual thing you've ever seen. So this is not at all unexpected. What was unexpected, however, is that the 10-year yield has come off so quickly. So we got a breakout, we got above 3%, got up to 3.25, but you can see now have very sharply broken that support, and this is as a result of the Fed changing their rhetoric on the rate of interest rate increases. So people were looking for 1 in December and then 3, possibly 4 in 2019. That would appear to be incredibly unlikely now. So that's what's been going on in America. In Australia, our dollar slipped down to 72.06, and that was a lot about the fact that the RBA is now, despite the RBA and of course politicians have been talking up the Australian economy all year. I've been referring to other indicators that really bothered me. And the RBA now seems to be changing their story, and one of the governors of the RBA has now indicated in a presentation to a forum through the week that that they may even entertain cutting rates and indulging in some quantitative easing. So that is an abrupt about face for the RBA, and as a result, the Australian dollar came off, and I think it's probably got, still got further to fall. The ASX 200 index was actually up by 14 points for the week, but that will be lost on Monday, I would expect, given the sharp fall in America on Friday night. The banks were the weakest sector of the market, as they should be, but there's many other stocks that are also going to be under pressure for the foreseeable future, and not just because of the selling, but because their fundamental outlook is not all that bright. So the outlook for me, for many of the top 100 stocks, there's a few where this doesn't apply, but for many of the top 100 stocks, the outlook is pretty somber, and it's really hard to see share prices going anywhere much for most of the top 100 stocks. So I just can't see where the upside's going to come from in the Australian index. The opportunities, I've mentioned this before, but to me there are only two areas of opportunities in Australia if you want to make some progress other than just owning stocks for dividends. So, I get that some people just want to do that. Just make sure that you're not owning stocks that have got a healthy dividend, but you end up losing 2 or 3 years worth of dividend in capital loss. But outside of, just a dividend situation, to me, the only two areas of relatively low risk, high probability growth opportunities are in undiscovered microcaps, which means that if they're undiscovered, they're quite possibly trading on really low PE ratios. And in the other area is really high quality growth stocks in the top 200 that become heavily oversold and undervalued. And there's more and more of those now coming onto the radar. So really looking for those for a rebound, not necessarily a long-term buy and hold, but pick them up for a 20-25% rebound and work them that way. So let's just take a look at the ASX 200. So we managed to break above 6,000 points. That really first occurred this time round in June. It only lasted through till October, and now we've dropped back down into this 5,600 to 6,000 point range, and we're right at the bottom. And as I said earlier, it really is pretty tough to see what's going to get this index back above 6,000 points again. Now, gold had a good session, and you can see we finally managed to break above the previous peak, which was at 1245. So we managed to break above that, finish the week at 1249. So we now have higher highs and higher lows in the gold price. So this is now starting to look more promising. So we now have a breakout. We had a wedge forming up here. We've now broken out. It's only minor. It can always turn out to be a false break. So I wouldn't get too enthusiastic about gold just yet. We need to see something a bit more sustained. We need to see this move up, come back, retest the breakout, and then move off again. So this could be many weeks yet before we get a more definitive situation with gold. But if we look at the weekly chart, you can see it's sort of clearer now that we've now got at least the makings of an uptrend in the gold stocks. If we look at GDX, this is a weekly chart. We're now starting to see a bit more positive response also from gold stocks. So a few brighter spots for precious metals. So we finished up 1249. Where to from here? It really depends on the macro environment. If this fear continues, I think gold moves a bit higher. But I would be, before I was really starting to ratchet up my commitment to gold and gold stocks, I'd certainly be looking for a move up, a retest of the breakout, and then see that breakout level hold as support. So GDX starting to respond now, looking a little bit better. Now, the environment where gold stocks could perform better has a couple of elements to it. Rate rises weren't good for gold because gold doesn't pay a dividend or have a yield. So a rising interest rate environment wasn't good for gold. That is now under some question. So we're now in a bit of a better situation. And we've also got fear. So fear is great for gold as well. So we're starting to see some elements come back in that are more conducive for the gold price. In other commodities, copper eased back about 3 cents to 2.79. This is really strange. The LME inventories, London Metals Exchange inventories, are still in downtrend. So the copper price is really defying the fundamentals and the outlook. This is playing out in the futures market because of perceptions about slowing global growth. But it's their perceptions. They may not necessarily come to pass. So all I can say at the moment that we know for sure is that the inventories are now at extreme lows, as you'll see, and we should have, unless the global economy absolutely falls on its knees, we should have a supply and demand deficit in copper for the foreseeable future. There's just not enough. There hasn't been enough reinvestment in the industry since 2012 to meet the demand. So I think we're in a situation where that supply and demand is going to be in deficit for several years. Now, crude oil did manage to stabilise after just a horrible 6 or 7 weeks where it lost a third of its value and managed to rise a couple of dollars to 52.5. So that $50 level is a key support level. And interestingly, with crude oil, inventories in America's finally stopped falling after, I think, 7 or 8 weeks in a row of falling inventories. So let's look at the charts. There's copper. It's really just been flat now for some time. But there's the LME warehouse levels. You can see just continuing to drop. That's the 1 year. And if we look at the 5 year, you can see that we're now below the lows of 2014 and 2016. So I'm not sure when the prior one was, but we're now basically at 5-year lows, coming into an environment where supply can't meet demand. So it's a real head scratcher for me why the price of copper is not responding. But anyway, at the moment it's not. There's crude oil, managed to just blip up a little bit after an intraday dip the week before below $50. So just to wrap it up, I think the important thing is there's a huge amount of noise out there in the market at the moment. There's a lot of negative commentary. There's hugely negative sentiment. but it's not necessarily consistent with the facts. So if you've got a game plan that you're comfortable with, then don't let it throw you off your game plan. There's always going to be periods where certain game plans don't work. There's no game plan that you could have that'll work through all market conditions. You can sort of tweak it around the edges in terms of adjusting your exposure, raising your cash levels to a degree. But there's always going to be periods where you go backwards. So don't change tack just because of all the fear and the negativity that's out there. If you're comfortable with your game plan, it's very easy to be whipsawed in this sort of market when we've got the incredible changes that we've seen in sentiment over the last 2 weeks. There's been 5 very significant shifts in sentiment on a day-to-day or even intraday basis. It's impossible to try and trade that market. Portfolio analyst this week, I'm just going to continue to be sifting through the opportunities. There's plenty of them. So that'll be the focus for portfolio analysts going forward. And of course, the other important thing is tactics. You've really got to, in this sort of market, you've got to think tactically about how you get in and how you get out of a stock. It's not just about looking at the stock and if it's undervalued or oversold, you buy it. You've got to think a bit more deeply and a bit more tactically than that. And that's certainly something that I'm putting a lot of focus on in Portfolio Analyst. It's the how-to. How do you build a position, and then how do you take profits? What are the signals to get out and take your money off the table? All those sort of things are so important. There's my contact details for non-members, and I'll be back with you next Sunday, and I'm sure it'll be another rip-roaring week. So that's it for this week. Cheers.